Do you want to know how to make money in Canadian real estate in 2023? Let's not sugarcoat it here. The Canadian real estate market is volatile, especially over the last 5 to 10 years. We all feel like there's too much risk to make a sensible investment in the Canadian real estate market right now. Rates are way too high. Interest rates just went up at record paces, and they're the highest they've been since the global financial crisis. We're probably entering into a recession if we're not already in one. You might be thinking, I can't make money doing this. And you're right to be concerned about investing in real estate in Canada. Your friends probably think you're crazy for wanting to buy real estate in Canada in 2023. All of these fears are based on two things. Number one is culture, and the other is emotion. From a cultural perspective, Canadians have been indoctrinated to think that real estate investment and income in real estate comes from capital appreciation. The US and Canada have similar cultures, but they view wealth creation differently. The American dream is business ownership, and the Canadian dream is home ownership or wealth creation through real estate. The way that money is made is through capital appreciation, and in Canada that's tax-free. But a lot of investors that I speak with and a lot of homeowners that I speak with who are counting on that wealth accumulation are asking me, how do I make money in Canadian real estate now that appreciation is gone? Have we returned to the long-term trajectory of growth in Canada where house prices grow at 6.11% historically since 1984, which is still a great rate of return, by the way, especially when you account for leverage? What about emotions and the media? There's no shortage of friends, family, and anecdotes in the media of people getting crushed by mortgage payments, by increases in interest rate costs, or by getting destroyed by values decreasing in a speculative investment position. Nobody wants to be house poor. I'm here to show you the real facts. This is real data that isn't based on the narrative or fear. And to be honest, I've been accused a number of times of being one of these people who is pandering or creating that fear in the market by having a more bearish market outlook. But the reality is I've stuck to a very specific market thesis or investment thesis throughout that period of time when I did have a bearish market outlook, and I've done fine as a real estate investor. If you can relate to these fears and you want to learn how I view the market, then this video is for you. I'm going to teach you how to make money in real estate in 2023, and to be honest, it was the same way that you could make money in 1993 or 1983 in Canadian real estate. Through this, you'll be able to buy an asset that will appreciate in value, just not in the way that Canadians have been indoctrinated to think. It's investing, not speculation. So let's jump into it. I'm going to divide this into 3 parts, and in the third part, I'm going to show you the tools that I use to advise investors on how to make good decisions regardless of the real estate market that we're operating in. Part 1 is the why. The why is establishing a market thesis or an investment thesis. In part 2, we're going to go through the where. We're going to apply the investment thesis that we get in part 1 and try and find cities in which you can make this type of investment in Canada without needing a $1 million mortgage. In part 3, we're going to cover the specific purchase. In this part, I'll explain exactly what type of properties to buy and the tools that I use to determine and analyze what is a good versus a bad investment. Part 1, the why. Canada's real estate market is very much moving the housing economy into what I would call a renter's economy or a late stage capitalistic economy. You can see this in countries that are much older than us, that experience their big waves of immigration earlier than we have, because Canada is just a very young country. The United States is further along on this curve, and their home ownership rate is lower than Canada's. Places like Germany or Switzerland or much of the Western world have experienced homeownership rates in decline and rates that are significantly lower than where Canada's homeownership rate is today. Data from Statistics Canada shows that the homeownership rate in Canada is in decline in almost every single province. That is a trend that's expected to continue over the coming decades. When you look at a low homeownership economy, what ultimately comes is a world where a lot of housing supply is owned by institutions or investments. And you often hear a lot of people talking about this in the you'll own nothing and be happy World Economic Forum conspiracy stuff. But the reality is there's probably an element of truth to a lot of that. And the question is, if you want to become a real estate investor, do you want to fall within that category of investor or institutional owners that are in possession of housing in the future? If you want to make money, I say yes. As a consequence of this secular shift that we're seeing in Canadian housing, rents are up in the double digits in most provinces year over year in Canada, according to data from rentpanda.ca. We're also seeing the tightest vacancy rate that we've seen in Canadian real estate in 2 decades, since the early 2000s. The national vacancy rate of under 2% and vacancy under 1% in some markets in Canada. This means that the rental market is massively oversubscribed. You always hear about how we're seeing record immigration, and it means that there are more people than houses for those people to live in. But where you really feel that is in the rental market, and it shows up in the data. At the same time that we're seeing rents increasing, we're seeing prices decreasing in the double digits. Prices in most major markets in Canada have seen significant declines since the peak of the housing market in February of 2022. Price is going down, but the income is going up on properties. This means that the yield, or the cap rate, which is a way of valuing a property based on its potential income, is increasing. Cap rate, or capitalization rate formula, is net operating income divided by the market value of a property. So the next part is figuring out where we can find investments that make sense from a cap rate perspective. As a rule, because interest rates have climbed so much, you need the cap rate of the property typically to be higher than the interest rate that you're using to purchase an investment property. So let's say you have a down payment of $100,000. I would say you could conservatively estimate to buy an investment property with about 70% down. For simplicity's sake, I would typically advise people to have about 1/3 of the property's value in cash when they're trying to make an acquisition. So a $100,000 down payment would enable you to buy something like a $300,000 investment property. So this is to cover your down payment, closing costs, land transfer, as well as a little bit of a reserve to make sure you're mitigating downside risk on the acquisition of the property. I'm all about mitigating downside risk, which is why I'm making this video for you today. So I put together this research for a company called Lendlord, which analyzes cap rates across different cities in Canada, and it provides a spread of what expectation you might be able to find a cap rate in each of those cities. On the chart, it shows a red line that shows the GIC rate, or the risk-free rate that's available in the market right now. And that is somewhere around what your mortgage rate is going to be. So typically you only want to be seeking investments that are in the markets that are above this line. If you are a non-traditional income earner, or for some reason you're not able to get credit from an A lender in the 5% range, you might be using a mortgage of 6.5% with a B lender. And B lenders have great programs for investment properties. If you're buying with a 6.5% interest rate, then you need to adjust your cap rate expectation to be above the 7% range. When you get into looking for cap rates above 7%, it does become harder to find them. And this is where you really got to understand what cities in Canada you can find investments within what category. And instead of breaking out a spreadsheet, you want to be able to use tools that allow you to calculate this exceptionally quickly, because agility and exposure to a lot of deals is what's going to make you refined and successful as a real estate investor. From my perspective, it is literally like 1 in 100 deals is a great deal. So statistically, you got to say no to a lot of opportunities. So you have to have a system to underwrite properties quickly. So now let's cover the purchase. As a general rule, there are 3 things that I would say make a deal good. Number 1 is you want it to be cash flowing. So you want it to pay more than its monthly mortgage payment. Number 2 is you want to have add value potential. And this becomes especially possible with Bill 23 that's coming in Canada. And number 3 is you want to buy a property that you can purchase below its replacement cost. When a bank goes and appraises your property and determines what they're going to lend against the value of your home, conducted by an appraiser who has a duty of care to provide an unbiased market evaluation of what that property should be worth. And it uses 3 different components. So the first one is an income approach. So what the property would be valued based on the income that it could earn as a rental property. The second is a comparative market analysis approach. So they compare the property to other sold properties that are similar to establish a value based on the average of those properties. And then the third is what's called a cost approach, or replacement cost new. To do this, they basically extract what the land value of the property might be, and then they take the value of the structure sitting on the land, or the house sitting on the land. And they'll usually depreciate the value of that house based on a assumed economic life of 100 years. So a house is an asset that would last 100 years. So if it was a car, it would be a car that you could drive for 100 years. And if the house is 50 years old, then they would depreciate it by 50%. To rebuild that house today, it might cost $300 per square foot. So if it's a 1,000 square foot house, it would cost $300,000 to rebuild that home. You want to buy a house that you can purchase below what it would cost to rebuild, even after depreciation. This gives you a hedge that you're basically buying the land value, which is the true intrinsic value of real estate, for a cost that is below zero. Let's return to the very beginning of this video where we talked about appreciation. And I said that I was going to show you an asset that would appreciate in value predictably and probably in line with the way that other assets appreciate without any speculative headaches associated with it. During real estate cycles, and especially during bull runs, when you see the value of all properties going up and interest rates often coming down, what you'll see is a phenomenon called cap rate compression. Cap rate compression refers to the rising market prices of investments in relation to the income that they earn. And you can see on this chart over time that cap rates typically drop during periods when house prices are going up, and then cap rates go up during periods when house prices are coming down. So what this is telling you is you can get better rates of return as property values are coming down. And then if you hold the asset through the cycle and into a period of appreciation, the property will not only be earning you income, but it'll also be appreciating the same way that a speculative asset like a house or a pre-construction condo contract would. The bonus is that you have a cash flow positive asset that's paying you money every month. It almost sounds like it's so simple and probably too good to be true, but the reality is so many people in Canada aren't investing in real estate this way. A big portion of this comes from the fact that since basically the 1990s, interest rates have been coming down and house prices have been going up, and people were able to get on board of that rocket ship and ride that capital appreciation to make good returns. The problem is this is akin to basically stock trading, and you have to sell the asset or refinance the asset or take on more leverage to make that investment viable or sensible. And it's not actually an investment, it's a speculation. So this is a lot to think about as a potential real estate investor. The first place that I would say that you should start is finding a city in which you see the rates of return that are cash flow positive for you and provide a cap rate that you consider to be safe and sensible and a good investment. The easiest way to do that quickly is using data from reports like rentpanda.ca's reports, or using tools like Lendlord.io's deal analyzer tool, where you can very quickly go through a lot of properties and get an idea for what cash on cash return you should expect from them, whether or not they're cash flow positive, and what cap rate you might earn on them. And you might have to look at different investments in cities across Canada. Cities in Saskatchewan, as an example, are places that you might be able to find a 6 or 7+% cap rate. There are even cities in Ontario, like Northern Ontario, Sault Ste. Marie, or Cornwall, Ontario, as an example, where you can get cap rates upwards of 6% if you're willing to make investments in probably rougher properties. The Deal Analyzer tool is completely free, and I recommend it because it saves me tons of time. I can underwrite a deal in a matter of seconds rather than a matter of minutes that it would take me before, or even hours that it would take me before to underwrite. The next piece is finding a local expert in one of these markets that you trust. And this has been one of the challenges that I've found difficult as a long distance real estate investor. And I'm probably going to do a video on how to find professionals like that. But if you'd like to be introduced to somebody who specializes in investment, as a host of Canada's biggest real estate investment podcast, I have a pretty solid network of investor-focused realtors in cities across Canada. We do meetups in different cities across Canada with real estate investors. And so I'd love to connect you with somebody who can help you on your investment journey. Thanks again for joining me. If you haven't already, please subscribe to the channel. This will help make sure that you don't miss any developments happening in Canadian real estate. Please like this video if it provides value for you. And as always, leave some feedback in the comment section. Comments always provide thoughtful and lively debate and discussion. And that's one of the big reasons I come here. That's all for me today, and I'll see you next time.